You're now plugged into the Delphi podcast.
Hey everyone, welcome back. It's Kevin from Delphi Digital, and today I'm very excited to be joined by Guilhem Chaumont, the co-founder and CEO of Flowdesk. Guilhem, really appreciate you doing this. How you doing today?
I'm doing good. Thank you very much for having me.
It's nice that we're doing this on a green candle day, which we'll get into the state of the market and all that good stuff soon. The marketing copy would describe you guys in Flowdesk as a full service digital asset trading and technology firm. But as we'll get into, there's a whole lot to unpack there. How would your elevator pitch, how would you describe yourselves?
Yeah, so I think the way you described it is actually the perfect way to describe the company. We come from a market making background. We were notably known with a product that our clients love, which is called market making as a service, which is a slightly different approach to regular proprietary market making. So we've been quite popular with that, but very quickly we evolved into a full service digital asset trading firm, which means that basically we talk to a wide range of counterparties, some of the biggest projects out there, some of the smaller projects, talk to institutionals, ETF providers, that gonna be banks, everything basically that touches crypto, and we try to offer those guys all the range of services you could expect in crypto. So indeed, that will go from market making, we do custody, we do brokerage on spot, derivatives. Now we are launching credit as well. So we have this, we're building this really like all service financial services firm, and at the same time, at heart, we are a hardcore technology firm because obviously in the back end is all the connectivity that we had to build and all the algorithmic and all the software.
Yeah, what I really like about your founding story is you initially were focused on the simple goal of providing institutional grade services, but for crypto native teams, right? I'm really curious. Maybe we can start there. What went into that decision making, and what was a kind of key insight or thesis you had for wanting to start there?
Yeah, so I think so. It was back in 2020. So we came with the following assessment. So I think at this time it was quite interesting because everybody was expecting an institutional wave, and they were all building in that regards. Those prime brokers, it's going to be regulated, etc., etc. And our deep conviction was that it would not happen for a wide number of reasons. We thought the market was not ready. We thought, no, it's going to be maybe for 5 years, for 10 years. This is going to be remaining like a crypto thing and crypto native thing with some various projects, infra. I mean, at that time, obviously, we didn't have a lot of the building blocks that we have today. So we thought, okay, we're going to focus on crypto firm. And where can the edge be? The edge can be a bit of a contrarian bet, which is to offer this institutional grade level of service, but to crypto native counterparties. And I think at this time, the market was missing a lot of that. A lot of things were shady, mostly proprietary market makers. Obviously, we didn't have at this time some of the market makers that we have today in the landscape. Regulation obviously was different. So we're like, okay, no, let's try to take a contrarian approach, institutional grade level of service, but to the smaller projects out there, and that's probably why we became so successful, and we anticipated, and I think we were right about that, but it's probably only the tip of the iceberg today, that this wave of token issuers will only increase, and they will get more and more institutionalized, more security token, RWAs. Obviously, those topics in 5 years have gone in the right direction, and we are very happy about it. But we thought, the building of this is to talk to the people who are in crypto right now. And at this time, it was only crypto native counterparties.
What were some of the challenges in those early days, but also I'm sure that you still face today in terms of, again, that focus on crypto native teams? If you go to any big company or especially, traditional financial players, the concept of market making, a lot of the services you guys provide is kind of table stakes, right? Or it's something that's very common. Whereas when it comes to crypto native teams, a lot of them might be very technology forward, but don't have the internal expertise to assess why they would need a market maker, things of that nature. I'm curious how those conversations went, especially in the early days of just trying to convince the market that what you were doing actually was value add and was something that eventually they were going to need.
So first of all, I'm going to state the obvious. When you have the ambition to do everything with a wide range of counterparties, wide range of products, you inherit from the complexity of wanting to do everything. So the best is to have a single approach on a single product, a single type of client. So I think we haven't made our life a lot easier by having this conviction day one in the company. And if you think about it, particularly when you think that the spectrum of token issuers you are talking to already back 4 years ago can be $1 billion market cap protocol heavily backed, but on the other side of the spectrum, you may have a $2 million market cap. a very small cap. And how do you address this range? It's extremely complex because obviously the cost of running market making in a fragmented market like crypto, when you talk about hundreds of exchanges, DeFi, CeFi, I mean, all the things that we know very well, it's hard. And that's kind of how we coined also this market making as a service approach, which is how can we address those thousands of token issuers who cannot afford to give 10% of their supply, who cannot afford to pay dozens of thousands of dollars per month for a market maker when you have like, tiny liquidity. We need to find something that is just very efficient and very transparent. And that's how the market making as a service approach, very cheap, very affordable, high coverage. You are your own market maker. About transparency, you do have to provide your own capital. You indeed take more risk because you take market risk, counterparty risk, etc. So, it was kind of like we tried to engineer the only thing that could fit for this market. And that's really how we came to it. And today, we are very happy to see that we still work with that side of the spectrum, and our clients are very happy, and we are very happy to work with them. And we can also work with the other side of the spectrum, which is also looking for some of the features of those products, including notably transparency and control over their token. So I think at the end of the day, we are doing crypto, but we are not reinventing the wheel. It's a set of financial services. There is a decentralization sort of flavor, but we are finding exactly the same problem. It's about regulation. It's about balance sheets. It's about coverage because we are in a 24/7, 365 business. So when you think about it, that's about having operations globally, trading, sales, monitoring of funds on chain, like all those sort of things, which just create an entry barrier that is getting higher and higher. And honestly, it's not the beginning of the end. So the game we're trying to play is be everywhere, do everything, be compliant in every jurisdiction we operate. It's a very long journey. That's why we think our journey is still quite early, and we keep building heavily and investing heavily, but it's going to be a very long journey. And the market will evolve a lot.
Yeah, to that point, if we fast forward to today, obviously we're living through very interesting times. There's a ton of uncertainty right now. The market looks quite different than it did 3 months ago, let alone 6 months ago. What's your current read on this market right now?
I mean, so to talk about the fundamentals and the numbers, the volumes right now are kind of anemic. To be very clear, we're down 60%, 70%, slightly above 1 trillion volume per month. We almost hit 3 trillion at some point. So the Bitcoin price, the Bitcoin face value is kind of hiding a forest of not much is happening. And obviously the altcoins and some of the altcoins have lost significant amount of value. So that's the current picture. The current picture is the market is basically as slow as it was before the whole US election and the whole activity that we saw last year. That's the reality. On the other hand, we have tons of reasons to be bullish on the long term, I think, and that's why on our side we're still heavily investing. And we have never really looked at the spot picture of crypto, which is why we always focused on keeping on building, and why we had so good results even in the worst conditions. And I think the fundamentals are very good. The regulatory clarity is happening, particularly in the US, of course, and we can do a lot of things. The institutionals are coming in. And this time, I believe it fundamentally. I don't think that they are coming in the way that people may think, and we can talk a bit about that later on. But that's where the flow is, and that means the market is radically changing its structure. I fundamentally believe that we are not in a 4-year bear bull cycle sort of structure. I don't think the flow is mostly retail anymore. All of those things we are witnessing. So the market structure is changing. So what it means simply that the market is maybe going to be more boring to some extent. Why? Because we are much more linked to the economic activity. We see it every day. Everybody is witnessing, what the US is going to do in terms of tariffs and what Trump may announce. But that's not really crypto linked per essence. So we can see a strong correlation here. We think obviously if you look at venture activity, most of it is priced now. So those good old days of doing 1000x because you invested in an early stage project, it's over because all those rounds are preempted at higher valuation. And again, also the venture landscape is going to drastically change in the next few years. So I think it's becoming a bit more boring, some would say. On our side, we are very excited because the thesis around institutional and tokenization, we see it arriving, and we are at the forefront of it, to be frank, given the projects we work with. But that's essentially it. So what we could expect this year, in my opinion, I don't think we are going to have the biggest bull run of all time and the highest multiples that some people would expect. But on the other hand, I definitely see think that whether or not we are in a bear market, we won't see those 80% retracements on Bitcoins, those sort of things. That's my deep conviction, and I think that's quite bullish for the space, because at the end, volatility, due whatever the reasons, including lack of liquidity, which bring back to our topic of market making, is not good. Is not good for the long term.
And why is that? You talk about how you don't expect to see these large, extremely large in some cases, drawdowns that we've historically seen throughout, let's say, the last, 3, really 4 crypto cycles, depending on how far back you want to go. You're saying you don't see necessarily that those times might be over in terms of those types of drastic drawdowns. Why is that? Is that because the way in which you're seeing institutions come into this space?
It's there are multiple reasons, but the number one reason that we are seeing is the flow are changing, and the view on the maturity is also changing. So to summarize, it's not the exact picture, but I think it will be a good proxy. Until today, it was, I'm trying to get in the bear market and I plan to sell in the bull run. I have this like 18 months, 2 years sort of view, 80%, retail driven. Now the people who invest most of the flow, and particularly in Bitcoin, do not have an 18 months horizon anymore. I think, and I think when you look at the flow of the ETFs recently, you clearly see it's a multi-decade TWAP, and money is just flowing in and is holding it in a similar fashion that people have been holding gold, for instance. So that's why I think essentially, the people who've been accumulating Bitcoin will not sell with the same horizon that the previous cycles were happening. I think that's the key fundamental reasons for what we are seeing. And obviously we are seeing it on Bitcoin first as a first order of magnitude, but obviously it trickles down to all the other coins to a lesser extent.
Gotcha. And that wave of institutional capital, which a lot of people have been looking for a number of years now, right? And to your earlier point, was never going to be a giant wave that came in all at once. It's more of a slow, progressive process. But when institutions do come in, they're stickier capital, they're longer term holders. Once they're making that decision, once they're in a sense. And it's not so much the retail, more kind of crypto degen, if you want to call it, type of trading mentality where it's very short term focused. The new players that are coming in have a longer time horizon, is what you're getting at.
This is what I'm getting at, and their perspective is extremely different. Those guys are not gonna hold top 500 of coins, do some TWAP and just wait. In my opinion, they will either hold the top assets, or what they will hold and what they will buy is the technology, and they will issue their own coin. So what I'm trying to say is what will bring crypto from a $2 trillion market cap to a $10 trillion market cap is not the increase of the market cap of the current token that we see. And maybe by the way, that may be bearish from a speculative perspective. It's going to be new assets coming into the space being tokenized. This is starting with the RWAs that we're seeing at the moment. So it's very important to understand that I think for whoever is expecting and waiting for that wave to basically pump their bag, I don't think it's going to happen much. That doesn't mean that the casino use case of crypto is over. This is going to remain a $1 trillion market cap. It will have ups and downs. There will be extremely good projects that will do, whatever multiple and all of that. But this is not a relay of growth. That's the point I'm trying to make.
And where do you see the most growth coming from going forward? Is it the tokenization side? Is it other new token issuers that are focused on maybe consumer? Where do you see the biggest growth areas going forward?
So I think we have 3 areas essentially. We have the store of value in a digital gold fashion. Most of that will be grabbed by Bitcoin, obviously. Then you have a few key network that will have some market capitalization derived from their revenues. Ethereum is a good example, and a good negative example these days. But as soon as you have a network that has a value of fees of 2 billion, 10 billion a year, you can easily derive some market cap using whatever high multiples. So I think there will be a lot of value in the networks. On the contrary to Web 2.0, to be clear, it's very different. And then the third is tokenization, obviously. And this is a 10, 15, 20-year process that will start with easy things. That has started, by the way, a long time ago with stable coins, with tokenized fiat. or to be more precise, tokenized money market funds, government, corporate bonds to some extent, with some of them. So it has already started a while ago, and it has been quite successful. The only key difference today is that the yield is passed on to the ultimate user, and that's very exciting. But I think this is where the next relay of growth is. So I think we will start with the simple use case. How do we bring the yield on chain? And if you think about it, it's interesting because even without crypto, this is happening more and more. On our side in Europe now, whatever bank you have, and I know it exists in the US, you have this, you deposit cash in your neobank, and you basically get the Fed funds rate or whatever the equivalent is. So it's happening on both sides. Obviously, the crypto brings a much better competitive environment and a very much more interesting flavor of it because you can tokenize it and you can move money around very easily. But I think it will start heavily with tokenizing the yield, whatever the yield is, and obviously then we're gonna go down to some much more interesting routes.
And do you see the rise of tokenization being more focused, or a bigger growth area being tokenizing or bringing on chain existing assets or traditional markets, or on the other hand, actually creating liquidity around assets that historically haven't either been illiquid themselves or haven't had liquidity at all?
Uh, Obviously, the wild dream is to have assets which were not liquid that they become liquid. So we are all, extremely excited about tokenizing, and that will start from pre-IPO sort of firms that will go down all the ladder until tomorrow the grocery store of the corner may have a $2 million market cap and distribute its dividend on chain. I think this will happen. And by the way, is the number one reason why we are building Flowdesk. But I think it will happen in a very long time because it's a very complex use case. So right now, what we are seeing and what we are thinking is the next 2 to 5 years will be dedicating to bringing existing assets that are already liquid, just to tokenize them and bringing them on chain and having all the positive sides of crypto, using them as collateral, transfer them easily. I mean, there is even a use case for crypto that I think that I think is quite possible, is the end of fiat money. Because tomorrow, if I get my salary with those tokenized money market fund and it's accepted as a payment on a one-to-one basis, who would want to hold fiat? We will just hold those tokenized assets, and I will pay you with it, you will pay me with it, and boom, and we have yield. And just that piece of the puzzle is an insane use case for the world, and is a $10 trillion market cap in itself. But I think quickly after, we will see the rise of a new waves of assets. And again, it will start with liquid assets. So the Tesla, the Apple, all those stocks, starting with the bigger one, will be brought on chain, will be used as collateral with whatever LTV. The companies may bring even their dividends on chain quickly. I think, Coinbase tokenizing their stock is probably the first stage of the rocket, and ultimately it will go down on all the ladder. But I think we're probably talking about 10, 15 years, and we need to appreciate how institutionals are very careful about this. And people are often wrong about, is it the technology ready? Is it their risk appetite? No, it's none of that. We need to understand that tokenization, banks are not going into it because the regulatory doesn't allow it. If you look at the ratios in terms of RWAs, so the risk-weighted assets, those are insane now. It was interesting because a few days ago, the French Public Investment Bank announced a crypto fund where they will invest directly in crypto, but they are getting smashed on their balance sheet for doing this. So there is also some regulatory, some Basel requirements which need to evolve at the same time. And that's why, by the way, the institutionals are starting with what looks like the easy stuff. But I think it's very exciting, obviously.
Is part of that hesitation on the institutional side also regulatory, obviously being a very big component of this? But when you dig a bit deeper, and let's say the regulatory kind of curtain was lifted, conversations I've had, but again, you've got a really good purview into this world. Institutions are also trying to figure out how they can capture fee revenue or capture the upside economics of tokenization in a world where this world that's crypto native is all about permissionless technology and decentralization. And I think I personally have a hard time sometimes imagining that some of these big, especially these big TradFi incumbents, are just going to come into this space without having a full understanding and plan for how they're going to be able to capture the upside from bringing a lot of these assets on chain.
I could not agree more with what you have just said. For them, it's a combination of what are the efficiencies that these things are bringing, and by definition, how much more money can we make doing the same thing, combined with the risk aversion of, we're not sure we understand 100% of these things. It seems that these things, they remove a lot of our value on the operational side, notably. So to which extent we are letting the baby go. And that's why they are, and obviously all of this with on the top, this thing can explode to our face because, this is on chain, there are hacks, there is security risk, there is protocol risk, PR risk, and obviously we're talking about crypto. So crypto is a hot topic for everyone. So that explains partially the risk aversion, but everyone who has a decent understanding of what's going on in crypto on the institutional side, and you just need a 10%, 20%. And I think some of the guys out there, like BlackRock, for instance, or all the other guys were issuing some sort of money market fund tokenized or stablecoins at the moment, have well understood this, see a huge advantage. And at some point, I suspect, of course, right now they are in a mode where they understand the synergies that it's bringing. They understand that they need to be careful. They need to understand that this can be a winning game or a losing game for them. But at some point, it's going to be a losing game for everyone to just not go into crypto. At some point, the risk will not be to go into crypto, will be to not go into crypto. Again, it's going to take years, but as the retail keep embracing this market, the investors on the buy side keep embracing these products, it's going to be a loss of opportunity for them at some point. But we could definitely understand why they are very careful about it. But again, you look at the numbers, you look at the TVLs of those stablecoin BUIDL token, it's exploding these days. And again, back to what I said, even if we think about the stablecoin market being 150 or whatever the number is billion market cap, it's ridiculous to compare it to what it could be tomorrow. We will be talking about 5 trillion, 10 trillion, those sort of numbers.
And when you have this type of longer term perspective and a pretty clear thesis on where you think the space is going, obviously today Flowdesk does a lot of different things. How do you think about where are the biggest opportunities within your market that you see right now, or what are the ambitions of how you want to go out and try and capture or be part of this evolution that you foresee in terms of both market structure, but the different types of players coming in? Like, what has got your attention most right now?
So, I think it's when you have a thesis that is as strong as the one we have and that we share with most of the market. So we're not making a contrarian bet here. Don't get me wrong. The question is, how do we get there? And how do we get there is it's a complex answer, particularly if you think that you're going to get there in 10 years. So the question is, what do you do now? And I think essentially everything we've been building in the last years is centered around that vision, building operations, building the regulatory framework. And to put it in a more simple manner, we think that we will trade those tokenized security exactly the same way we trade utility token today. And by the way, utility token won't die. There are some very interesting utility token, and that's probably going to be a single-digit trillion market. It's not going to be two-digit trillion, but we think there are some very interesting tokens out there. But my point is, we will trade the security token exactly the same way we trade them today. So what I'm saying is ERC20 tokens on pool, some RFQ on chains, some centralized exchanges. They may be centralized exchanges, of TradFi. They may be Robinhood, whatever it can be. But at the end of the day, the technology is there, and it's going to happen exactly the same way. Of course, it's going to be permissioned, very likely, because you need to know who's buying. You need to do KYB, KYC, KYT, all of that. But essentially, what we're building at Flowdesk is the technology for that. That's our deep view, and we don't think that it requires any additional technical infrastructure improvement. We think we have that since the L2s came in. The fees are variable enough for any transactions, and we think it may change. And if it does, by the way, we will be at the forefront of innovation, so we'll be very happy. But we think that part of the puzzle is done. And now it's only a matter of time until it happens. And until then, we will watch the TVL of all those assets grow every day. So now what we are looking for in the markets is just helping the current players in the market, whoever they are. Obviously, we come from a strong background of working with crypto native firms and token issuers. So we try to help those guys on all fronts. We think, just like I told you, that when we trade with security token tomorrow or utility token, stable coins, we will trade the same way we trade with our clients today. They are looking for credit capabilities. We can bring them credit capabilities. They are looking for various structured products to bring an additional yield. We can do that. We're doing it with the top foundations out there. So, all those things is just, trying to keep that long-term vision, but build bricks that make sense for the ecosystem today and that will make sense for the ecosystem tomorrow. But it's very interesting to see that, now the strongest demand that we have in terms of client is stable coins. We are we're incredibly excited about the stable coins that we see out there. Everyone is launching stable coins. We're working with some of the biggest out there. What's happening on security token side is also very interesting. Less and less is happening on the infrastructure layer side. Obviously, there is a huge, almost philosophical question about where is the value going to be? Is it going to be EVM? If it's EVM, it's going to be on layer one, on some layer twos. We see also, those chains RWS compliant day one coming in. I think that's an interesting use case. But yeah, the road is very long. So our job, obviously, and that's where we become risk averse, is to make minimum bets in terms of where we want to be, because we think our job is to be everywhere and to adapt to the future evolution of the market.
When you say demand for stablecoins is one of the areas you're seeing the most growth in, or the most demand for, per se, how exactly does that manifest, or what specifically does that mean?
I think something is happening, and stablecoin demand is really happening, driven by the retail. That's one of the interesting retail thing, on the contrary of what I said before of institutional coming to market. I think there is a real adoption from the retail market to start using stable coins, and obviously we know it came more from countries with lower GDP, lower access to banks, but I think it's happening. We see now 2 digits percentage adoption in some of the countries, used on a daily basis. We've all been paid by some friends in stable coins. We see people in our families who are not necessarily 100% crypto savvy who start using stable coins and what people don't understand is, to have crypto adoption, we don't need people to fully embrace crypto in degen mode, and they all have a ledger wallet. I mean, having a wallet in your smartphone with $1,000, $2,000 of stable coin is perfectly enough to do your daily operations, just like you have your credit card and you pay this and there and you don't really think about it. So I think that's where the demand is. And there is also a self-fulfilling prophecy of the offer is creating the demand. Now, for a wide number of reasons, a whole bunch of people want to create stable coins, because obviously they've seen some very good returns, they've seen some exits, lots of that. So they want to get into, and they are also creating the narrative and the marketing to start onboarding. Banks are distributing it. It's no secret that we work with some of the largest banks on their stable coins. They are creating the demand for it. Right now, it's mostly driven by retail, but the second stage of the rocket is having banks using those stable coins to settle between them, to collateralize with them, put those stable coins in some credit support annex as they trade derivatives. So again, I think we're talking about 3 years, 4 years, 5 years, whatever it is. But I think this is what is driving the demand right now.
Yeah, and I've got a pretty, we'll call it outlandish question, which we can certainly cut if you don't want to answer or feel comfortable answering. But to put it bluntly, what's to stop you, or what would stop you from issuing your own stablecoin and then having that work within your own ecosystem, and the liquidity aspects, and again the additional revenue you could drive from issuing something like that? I'm curious, like, what would stop you from doing that?
So it's been a question that has been asked very often to us, and to a wider extent. Why wouldn't you issue a stable coin, a tokenized money market fund? Why wouldn't you issue your Flowdesk own coin, utility token? It seems that it's an easy money grab, or whatever it is. Our answer has been always the same, and it will remain always the same. We are being seen more and more as a transparent player, a trustable player, which sounds kind of ironic into a world where we're trying to remove the trust. But I think this will never happen. With no conflict of interest, as I said earlier, we're not trying to bet on one pony versus the other. Like it's almost a philosophical approach that we have to it, that we think is very, very important. Because once you're linked to a certain ecosystem, once you start building your own products and start distributing them, then are you really being fair? And that fairness, that trustability, has a lot of importance for us, has a lot of value. We think it will have even more value in the future. That's why the counterparties trade with us. So ourselves, we will never see us as a company investing into building a product that is like directly client facing, and that we have to advertise and advocate for it, because what that would mean, it would go against the interest of our own clients. So we know exactly where we are in the food chain, and we don't want to go elsewhere, even though it sounds quite appealing, considering that we have obviously the technology, we obviously have a good understanding, we have the distribution, we have the regulations. It could be easily doable, but I think when you look at the complexity of the things we are building already in our realm, we have a lot of food on our plate to do a lot of things for the next 10 years. So I'm not too worried.
Certainly, and I think that point around trust is a really important one. Before we turned on the camera, you and I were chatting briefly before this about how I think that a lot of people probably have or would like to think they have a rough service level understanding of what market making is, specifically what companies such as yours provide. But digging into that a little bit, what do you think is one of the biggest misconceptions about market making? And then on the trust side, when it comes to teams that you're working with, right, token issuers, what are the critical questions or things they need to know before engaging a market maker?
Thank you so much for this question. It's a quite interesting one. So obviously, the biggest misconception about market making is that it works potentially against your interests. If you work with the right market makers, it's EV positive for your token. So assuming you're working with the right market maker, and honestly, there are more and more very legit market makers, even some of the biggest out there who have been put wrongfully in the light for what the market was thinking was the wrong reason. No, they are legit people, and they are just trying to do their job. And at the end of the day, a market maker is supposed to be delta neutral. So if you are delta neutral, that means that you are not betting on the success of the token. You're just buying and you're just selling, and you're just trying to monetize the spread. So you buy a bit lower, you sell a bit higher, but you don't do that over a 6 month period. You do that over a millisecond, sometimes almost microsecond sort of period. So that's the first misconception, is that the market maker is making money on your back. Of course, if your market maker is using all their inventory to basically dump your token and enter a big short in your project, that's another thing, and that's another debate. But let's assume that market makers are doing their job. So as a project, what you should look like is let's go back to the fundamentals. You have a token. You are basically doing an IPO day one. You're going to be listed on multiple exchanges. Your token is going to be traded against multiple currencies. Some of those currencies are going to be fiat, stablecoins, some other assets like ETH, and so on and so forth. What will attract demand for your project is two things. Is it a good project? Fundamentally, does it has good fundamentals? And if you think about a security token tomorrow, does it have good financial ratios? PER, those sort of things. Does it distribute dividends, etc., etc.? And the second thing is, how quickly can I get in, get out? People need to understand that, and that's particularly going to be true for institutionals. They have liquidity requirements. How fast can I get in and can I get out? When the funds get regulated, that's a question that is asked by the regulators, and they categorize the assets in different categories. So the first thing investors will look at, and that's even true for retail investors to some extent, what is the depth of the order book? If I buy $1,000, $10,000, $100,000 worth of token, what is going to be my execution? If my execution cost is 5% to get in, 5% to get out, that means that if I want to get in, get out the same day for whatever reason, I lose basically 10% of my money. So the liquidity is how you attract investor and how you reduce volatility, because those two things are positively correlated to attracting investors. So that's the number one reason you hire a market maker. You want your book, and you want to have precise KPIs from your market maker, how much liquidity I'm going to put in the book. And then we could talk more into the details and into numbers if that's necessary. But yeah, it's not putting liquidity very far away from the mid. You want typically to have a bid-ask spread for a legit token to 10 to 20 BP sort of spreads. You want to make sure that you have a decent amount of liquidity. You want further liquidity in the book. You want to have a decent uptime. 95% is very reasonable. So there are a whole bunch of metrics that projects should look into. And at the end of the day, they should compare what they pay and what they get for it. And that's just like anything in life. For the same thing, you could pay 10x the price talking to different competitors who have different acts to trade your token a certain way, different connectivity to exchanges. So at the end of the day, the way I will summarize it is, look at the KPIs. What are the numbers saying? Pick what you think is the best market maker, the most transparent one, the one that aligns the most with your interests. Some market makers will try to extract money from your project. Some market makers will just try to provide liquidity and just extract market making just from the spread and taking arbitrages. So that's two very different approach. Is the market maker directional in the underlying? That's what I'm talking about. You definitely want someone who is market risk neutral, and at the end of the day, the market is evolving in the right direction, and it takes time. This is still a market that is in its infancy. So the track record of market makers will speak over 10 years at some point.
Yeah, I think a good way to try to understand this idea is also to kind of flip that question on its head and imagine a world in which what do crypto markets look like if firms such as yourselves didn't exist?
Yeah, It's a very good point. I mean, there would be two things. So first of all, it wouldn't be a disaster as much as people could think. Why? Because you would have simply proprietary trading firm operating on a full discretionary basis, not having any links with projects, who will be here basically to monetize. So, it's we're not going to give any order of magnitude. It's completely indicative, but it's not going to be 1000x, worse. There will be people taking arbitrage, even retail market, putting orders in the book, limit orders manually and trying, to reduce that spread and sort of and so on. And so on. But obviously, if there were a market maker, we would be looking at completely different volatility. I mean, if you look at the top assets like Bitcoin and ETH, obviously market makers, even the pure proprietary one, have limited impact. It's very clear, because when you look at the liquidity of the, but for all the rest of the market, you would be looking at much more realized volatility. So take any asset of the top 100 coin market cap, top 50, you would be looking at 200% realized vol instead of 80, 100%, whatever it is. And particularly when you need a market maker is in the worst moment, when everybody is out of the books. In the extremely volatile, in the volatile event, you prefer to have a drop by 20% in your token instead of going to 70, or even eating and going through the full order book and virtually going to zero, and then of course spiking up. You want to avoid that. So I think market maker clearly play a very efficient role in the market. It's been demonstrated, by the way, by the literature, that assets who have a higher liquidity tend to trade at higher multiples. There is a premium for liquidity. So that's essentially a very important thing. And whether it's through relationships with token issuers directly, with banks, some of the brokers out there, market maker will persist in some sort of new fashion, as crypto has brought it. It's a slightly different model than in TradFi. Will it become very similar to TradFi? Maybe. I don't think so, for wide reasons. But yeah, clearly market makers and financial services player in general play a key role in the industry.
Yeah, and as this market matures, and we talked a lot about how institutions are coming in and the ways in which they're coming in, how do you think about moats around the business that you've created, especially if and when we start to see big traditional finance incumbents come into this space?
So there are multiple ways to look at it, and obviously nobody has the answer. So the first thing that we should really be clear about, and that's irrespective of new incumbents, big firms, the entry barrier is getting higher and higher, as I was stated before. In the world of today, in the world of tomorrow, you cannot operate this business without having the right regulation, the right people, and the balance sheet. This is becoming a balance sheet game. So, and to be very clear and very honest, we created Flowdesk a few years ago, and we created with limited means. We raised funds very quickly, and that was fantastic, but it was a very small team. So you could hardly do that today, at least not with the ambition and the velocity that we did. The entry barrier is going to get bigger and bigger because it's just becoming more complex and it's just becoming more competitive. We're talking about, market making. How do you find your market maker? If you look at the implied price of getting a market maker, it probably has shrunk by a 10x factor in the last 5 years versus 2021. If you look at the percentage of supply that token issuers were doing, and I'm happy that with our very limited means at Flowdesk, we have contributed to that to some extent through our market making as a service approach, which is arguably 10x cheaper already. So I think what will happen is very simple. The theory is institutionals, banks, we want to embrace crypto for all the right reasons. We talked about it. We'll talk about it before. We think that it's going to be nearly impossible for them to build it because the complexity is a higher one order of magnitude above doing it in TradFi, and it's slightly different. Where in TradFi, it's centered around single trading venue, high frequency trading. Here it's a fragmented market. It's you're touching assets, you're touching exchanges that you have less readability on it. So the complexity is different. So we think the only way that they would want to embrace it is either working with people, buying some technology, buying the firms, or buying the technology directly. That's why there are lots of bets made on the infrastructure side of trading in crypto at the moment, and there are some really good firms that have emerged out there. So we think that's the only way it can happen. Some of them will try to invest. They will invest a lot of money. Maybe they will be successful. Probably some will be, but most of them will realize that the complexity of crypto is so high that it's probably better to partner with existing people. At least That's what we think and that's what we hope, very, very selfishly, to be frank. But also there is another interesting scenario, as we talked about, crypto itself being a threat to institutionals, is maybe we will witness through this reshuffling of cards the emergence of crypto native firms that become very big, arguably, larger than the current institutionals. This is a bet probably that has low probability, because when you look at the track record of those firms, the regulatory, the size, the balance sheets, you will be like, well, okay, no, those big banks are going to remain the big banks. But after all, why not? Why not? And that's why, as an ecosystem, we should be very ambitious about just providing the best that we can for our clients as an industry. And if it means we can replace what is existing and we can do it in a better way, let's do it.
Given the barriers to entry are only getting higher and have only gotten higher over the last 5 years, to your point, I won't ask you if you today hadn't launched, if you would try to launch and build a company like Flowdesk, but if you were starting from scratch, what do you think it would take capital wise to actually be able to compete?
I can answer you the question. I will still do it today because I'm very naive, and I realize the risk, and I realize how much of a hard battle it is. Only a few years later, when I have a few gray hair on my head. So I'm way too naive to think about all these things when I'm building it, and it's more a self-reflection. Having gone through this. So I think today there are multiple things. So first of all, yes, the entry barrier is higher in crypto and in crypto trading, but you could run a similar parallel that launching any new startup today is probably harder because there are more competitions and everything. But the tooling is incredible. And when I say tooling, I mean obviously both the crypto tooling, like it was a pain in the ass 5 years ago to do anything crypto. Could talk about cybersecurity. I mean, obviously we've had some really good custody provider, technology provider that arrived and that solved those topics, and they were almost non-existent 5 years ago. So the building blocks are much more solid today. The blockchains themselves are much more solid. Of course, I'm not even talking about AIs. The way we developed Flowdesk. I'm still the CEO and CTO today of the firm. It was a very different way we did it 5 years ago. We had Stack Overflow. Today you have OpenAI. You have all the AI that you want. So it's becoming more easy on the tooling. That's 100% sure, and that's why I would still do it today. However, the entry barrier to launch a trading firm today, and again, it depends on the vision. If you want to run a similar prop shop, maybe close a few deals with token issuers, you do that from a single country, the coverage is not going to be excellent. You don't necessarily have to be 100% compliant because you will be under the radar. You can do that, and you can probably run a single dollar million business quite easily doing that and be very profitable. I don't think that's good quality for the client. I don't think that's sustainable over the long run, but arguably you could do that. If you want to launch a business that is global, regulated, that has similar equity story as we had with Flowdesk, we are already talking about a high two-digit million-dollar balance sheet. We are already talking about probably 40, 50 people between sales, trading, and operations globally. And what I'm not even mentioning is an uncompressible timing, which is the regulation. To get regulated, it takes years now. And we were one of the first we were actually the first regulated trading desk in France. It was back in 2021 or 2022. It took us 3-4 months to get it. We did some really good work, and probably we were a bit lucky. And the regulator was very constructive at that time and very favorable. Today, there is not a single legit regulation that will do this. Like you look at the UAE, for instance, which has a very interesting framework. We're talking about hundreds of companies who are waiting to be regulated there. And on top of that, the requirements are much higher. So, you have all these things where basically you need more money, but also you need time, and money cannot necessarily buy time. It's not one or the other. But I think, it's good to see that there are still new incumbents into the space, because those new incumbents are going to be as naive as we were a few years ago, and maybe they will crack things that we haven't figured out. And all in, that's very positive for the space, because at the end of the day, the clients, whoever they are, from token issuers to institutional, they will benefit from that. So I strongly encourage people to keep trying things and hopefully bring something positive to the space.
Yeah, I think that's a really, we could talk for hours about all of this stuff, and unfortunately we don't have hours and hours. But as we kind of get towards the end here, I think one of the things I wanted to wrap on is, as we look to the future, recently you guys announced a very big financing round, had some actual very reputable players involved in that. I think most notably BlackRock, or at least debt managed by funds by BlackRock. Where are you investing most right now? Like, where are you really pouring fuel on the fire, given what you expect over the next 12, 24 months?
Yeah. So you know, we obviously at a stage at Flowdesk where we are very lucky not to have, you know, a very healthy business from a financial standpoint where we would not need to raise any further money, arguably today. And we are obviously blessed to have incredible people around us. You mentioned BlackRock among others. That's really good. So for us, it's very simple. I think I told you a bit earlier that we try to filter the noise from crypto, and you know, we try to be a bit bullish when everybody's bearish and a bit bearish when everybody's bullish. And we have a roadmap of, you know, keeping on doubling down into everything that we do. So that's where those funds will be poured. So more than ever, we are doubling down on the infrastructure side. We're trying to build the whole suite of technology products that allow us to trade any asset, any token, everywhere, enable our clients to do that in the most cost-efficient manner. That's a lot of technology. That's a lot of investments. We are very happy to pour our funding round and our profits into that mission, which will take years. We're doubling down on our own people because, as I stated, arguably you could run this business with 15, 50 people, whatever it is based on your ambition. But the firm of tomorrow, that very big firm, you know, multi-billion, dozens of billions of dollar valuation financial service firm, would definitely not be a 30,000 people firm for a right number of reasons. We were talking about a few hundreds at least. So us, we are just doubling down on trying to find the best talents who fundamentally and deeply love crypto. And when I say it, it's very important. And those people are rare, but they exist and they are just incredible. We are building on the long term. We understand that building a firm and being part of such a journey is a different timing than, you know, just trying to speculate over the next coin and just trying to get rich in a 1 year or 2 years sort of horizon. So we are building all of this together with a lot of naivety. And obviously the big challenge that we have is how do we scale our balance sheet? Because to get into that point and being that firm, we arguably need to 100x our balance sheet. We're going to do that with our profits. Maybe we can buy time, you know, another way. That's partially why we also did this round and why we'll do the others. So, you know, again, trying to tick all the pieces of the puzzle at the same time and invest energy into what we think the future will look like. We talked a lot about tokenization. That's our big battle now. We're not forgetting all the other aspects of the ecosystem because we love what everyone is building on the infra side. All those utility tokens, some of them are not really useful, some of them are very useful, but that's the market will decide eventually. That's not our call. We're not here to judge if a token is good or bad. We're just trying to provide them the best financial services in the most transparent way, and we let them do their own journey. So, you know, I think this is essentially what we are looking at, and we couldn't be more excited, obviously, of where we are today. But it's going to be another 10 years journey to get to where we think we can get.
Certainly. And you beat me to the punch on what my final question was going to be, which was we talk a lot about it, all the exciting things, and you're, I think, similar to me in terms of being almost a perma optimist, right? But what is the biggest challenge that you and the team face right now?
So there are multiple ways to answer this question. The first way to answer it is more as an entrepreneur and CEO is the people side of things, because, you know, when you start a company in a very naive way and you have more an engineering background, technology background, you build things, it's a small group of people, and then, you know, it becomes just unmanageable. But fortunately, we have incredible people across the firm who are making sure that everything holds up together. So, you know, it's a people battle. It's the biggest challenge for every firm. People say it the first time you hear it, you think it's bullshit, and then when you build your own company, you're like, holy smoke, it's true, because that's fundamentally everything that it is. If you have the right people, or you can be lucky, you can be a good shot caller about this will go up or this will go down, but assuming you need this anyway, then you need the people. So the people is a huge challenge, and how we get there. The regulatory side of things is a big challenge for us at the moment, particularly as a European-based firm, because obviously we have MiCA coming into practice. Exchanges are starting to delist USDT, for instance, non-MiCA compliant stablecoins. We even came across something in the recent days where one of the largest exchanges didn't want to list in Europe a coin that didn't have on-chain traceability supported by, you know, the chain analysis, the elliptic, and others. So this is where we are heading. And as usual, you can see the glass half full or half empty. Half full, half empty, you're like, we don't have business today. And half empty, we know that this is what probably will enable the next wave of the business for banks to be reassured and to prove that they are compliant in every way. Other challenges, obviously, we are facing is keep scaling our technology with the same pace that the market is scaling. Cybersecurity, more than ever, we saw it in the recent months. The threats are probably at all-time high in crypto, and arguably we are probably a prime target too. So those are the sort of challenges, but fortunately we touch wood and we have an incredible set of people working with us. So for us, we just try to make it happen every day, and that's already a lot.
Yeah, no, I'll double click on that last point too. Having the right people in the right seat is arguably the biggest unlock for growing and scaling a successful business. Absolutely.
So true.
Guilhem, really appreciate you hopping on. I'm already excited for our next conversation. We'll do this again. We'll get some updates on where you are, where the market is. I'm really curious to see how this thesis plays out. There's a lot that we unpacked here. So really appreciate you joining me today.
And so do I, and thank you very much for the opportunity.